Back to closing bell, the S&P 500 staging a modest midday turnaround to the upside. Still on track, though, for its second negative week in 3. Yet the bull run isn't over yet, according to our next guest. Ed Clissold, chief U.S. strategist at Ned Davis Research, sees two major market forces that should drive the next leg of the rally. Ed, good to see you. I know you probably been contending like everybody who's watching this market with some mixed messages, right? It was a pretty good rally off the October low, but it didn't necessarily check off all the boxes to say this is a true high momentum bull market. But what are you seeing in your signals that embolden you to maybe nudge equity exposure up recently?
Yeah, thanks, Michael. We have been overweight equities since January, and we added a little bit more exposure earlier this week. And there were two reasons for that. One is that a fair criticism of the rally coming off of the Silicon Valley Bank debacle was it was very narrow. Just a handful of stocks were driving all the gains. But that's changed. It's broadened out considerably. If you look at percentage of stocks above their 50-day moving averages, that's gotten well above 75%. If you look at percentage of sub-industries, there's about 150 sub-industries. Almost 80% of them are in uptrends. So that's a pretty broad rally. And the second thing is that there's been this concern over a looming recession because growth has been weak. The Fed's been so aggressive. But the recent economic data, if you look at the jobs data today, the ISM services report the other day, and some other economic data, and it's suggesting that an imminent recession risk is pretty low. So maybe that could happen next year, but that enables the rally to continue for a little bit longer, even if the Fed does raise rates in a few weeks.
So what are some of your other inputs suggesting at this point? Things like, valuation overall, or even some of the sentiment metrics that you carry. Are they also feeding into this idea that there could be more room?
Yeah, those are a little bit mixed. But if you look at absolute valuation, just the PE for the S&P 500, it's not that far above its long-term average. The challenge there is relative to short-term interest rates. It's probably the first time in about 20 years that cash has been a very reasonable alternative to stock. So that may cap the upside in stocks somewhat. When you look at investor sentiment, Michael, that had been a really positive part of our indicator suite. People were so concerned about a recession, about the Fed for so long that any incremental piece of good news was probably going to nudge the market higher. Now, some of those bears have come off the sidelines. There's a little bit more optimism. Usually when you've been pessimistic for this long, months and months on end, the first move into optimism isn't necessarily a bull killer. It's if it stays there for a long time, that would be more of an issue, which again is a reason why we think the rally could go on for several weeks to a few months more before it runs into trouble.
All right. And is there a particular level of yields that would become more of a concern? Or I guess if yields fell, would that refresh the bull case?
Yeah, so I think from here, another 25, 50 basis points in Fed rate hikes to push the 3-month towards 6%. At some point in there, it would probably mean, the equities are even less attractive. I think it has to do with the speed of long-term interest rates. If you get a 7,500 basis point move in just a few months, the market tends to really take notice. But if it's a slow climb higher, the market can usually digest that okay. So that's something that we're keeping an eye on, the level, but also the speed of the move in interest rates.